Becoming a landlord doesn't require tens of thousands of dollars up front. In fact, many successful investors have entered the real estate market with little to no cash. A surprising statistic reveals that over 44% of rental property owners started with small investments, often using creative financing to make their initial purchase. The traditional path of saving up for a hefty down payment and securing a bank loan is not the only option. For those who feel blocked by financial barriers, the reality is much more promising. Breaking down the financial barriers. The idea that you need a large sum of money to start investing in real estate is one of the most persistent misconceptions. Conventional wisdom dictates a 20% down payment, enough reserves to handle unexpected repairs, and a strong financial cushion. For many, these requirements make real estate seem unattainable, especially in competitive markets where property prices are high. The fear of financial risk keeps around 40% of potential landlords on the sidelines, preventing them from exploring real estate's potential as a path to financial independence. However, with the right strategies, you can bypass these challenges and get started even with limited cash. Let's look at how savvy landlords are making it happen. Seller financing is a powerful method that allows buyers to avoid banks entirely. Instead, the property owner acts as the lender, enabling the buyer to make payments over time. This approach can eliminate the need for a large down payment, and often results in more flexible repayment terms, like lower interest rates or deferred payments. Consider a scenario where you negotiate a deal directly with a seller willing to accept monthly payments, allowing you to acquire a rental property without traditional financing. Tip: look for motivated sellers who are eager to close a deal quickly. These situations often lead to favorable terms. Lease options or rent-to-own are agreements where you lease a property with the intention to purchase it later. A portion of your monthly rent is allocated towards the down payment, giving you time to secure a mortgage while managing the property. This strategy lets you lock in the purchase price while gradually building equity. Tip: ensure the lease agreement clearly specifies how much of the rent goes toward the purchase and confirm the seller's commitment to sell at the end of the lease period. Partnerships allow you to pool resources, skills, and expertise with others. This approach can be particularly useful if you have market knowledge or property management experience but lack cash. By partnering with someone who has the capital, you can both reduce risks and share responsibilities. Tip: draft a detailed partnership agreement that outlines each party's responsibilities, financial contributions, and profit-sharing arrangements to avoid future disputes. With subject to financing, you take over the existing mortgage payments from a seller without having to qualify for a new loan. This method is beneficial when dealing with a motivated seller who wants to transfer the property quickly. The mortgage stays in the seller's name, but you assume control of the property, avoiding a large cash outlay. Tip: conduct thorough due diligence on the property's condition and ensure that the existing loan terms are favorable for your investment goals. Private money lending involves borrowing from individuals rather than banks. These lenders could be friends, family, or acquaintances willing to invest in your venture. Private lenders are often more flexible with their terms and may not require a perfect credit score. The property itself acts as collateral, making this a viable option if you lack traditional financial credentials. Tip: always secure private loans with a formal agreement outlining repayment terms to maintain transparency and protect relationships. Hard money loans are short-term, high-interest loans secured by the property's value rather than your financial history. They are particularly useful for properties that need renovation or flipping. Once the property is updated and tenanted, you can refinance with a traditional mortgage, recovering your initial investment. Tip: be aware of the high interest rates and fees. Plan an exit strategy like refinancing to avoid long-term costs. House hacking involves buying a multi-unit property, living in one unit, and renting out the others. The rental income covers the mortgage, potentially eliminating your housing expenses. This strategy is ideal for first-time landlords because it allows you to live in the property while generating income. FHA loans, which require as little as 3.5% down, are often used for house hacking. Tip: ensure the rental income will comfortably cover the mortgage and any additional expenses, such as maintenance and property management. Seller concessions. In a buyer's market, you can negotiate seller concessions, where the seller agrees to pay certain costs such as closing fees or repairs. In some cases, sellers might even contribute toward the down payment to make the deal more attractive. This tactic can significantly lower your upfront investment. Tip: use seller concessions strategically in negotiations to reduce initial costs without impacting the overall value of the deal. Credit card financing. For smaller expenses related to property acquisition, such as minor repairs or closing costs, some investors use 0% APR credit cards. This option requires careful management to avoid high-interest debt, but it can be a useful tool for short-term funding when traditional loans aren't available. Tip: only use credit card financing if you have a clear plan to pay off the balance before the promotional interest-free period ends. Success stories from zero to real estate investor. To illustrate how these strategies work, let's look at the stories of David Green and Chad Carson. David started with limited funds, using the BRRR strategy: buy, rehab, rent, refinance, repeat. He leveraged hard money loans to purchase and renovate a distressed property. Once it was tenanted, he refinanced with a conventional loan, pulling out his initial investment to repeat the process. This approach allowed him to scale his portfolio without needing a significant initial cash reserve. Chad Carson began with a similar mindset, using house hacking to kickstart his journey. He bought a small multi-unit property using an FHA loan with a low down payment. Living in one unit while renting out the others enabled him to cover his mortgage, freeing up funds for additional investments. This strategy not only reduced his housing costs, but generated passive income that he reinvested, steadily growing his portfolio. Conclusion: creative financing isn't a shortcut but a smart way to leverage opportunities in real estate, even without a substantial starting capital. Understanding these strategies, seller financing, lease options, partnerships, and beyond, can be the key to breaking into the market. It's about using resourcefulness, negotiating skills, and a willingness to think outside the box. If you've considered becoming a landlord, but felt constrained by financial hurdles, now's the time to explore your options. What's holding you back from taking the first step? Share your thoughts in the comments, and don't miss our next video on the Wise to Rent channel, where we delve deeper into these strategies for real estate success. Subscribe and join the journey towards financial independence, one creative deal at a time.